Hope everybody's okay. At least I saw the numbers going down yesterday. Hopefully it'll go down again today, so that when I'm back in Brunei in 2 weeks' time, we'll be, not too bad. At least my quarantine is only 1 week when I go back. Okay, in terms of lectures, after this lecture, there's only going to be 2 more. Then I've finished all the syllabus. I will see whether I can cover the last 2 topics probably next week. Then we don't have any more lectures left. Yeah. So apart from after today's lecture, there's only chapter 19 and 21 left. Computing taxable total profit and also losses. The losses chapter is quite short. It's only got examples. So maybe I might cover both next week. Then that's the end of your lectures. If that's okay with you. Yeah. So in terms of coverage, I would have covered certainly more than 60% of the topics anyway. Yeah. So today I'm going to cover 2 chapters, which is a continuation of chargeable gains, but concentrated on shares and securities for individuals. Yeah, chapter 16, and chargeable gains for companies. In terms of the concept, in terms of the approach, is pretty similar to both, but there's only some slight differences. Yeah, which for example, purposes, you would have to memorize some of the rules, which you don't have to now. Okay, so just a recap what I mentioned last week. Yeah? What the chargeable gain is. A gain is chargeable if there's a chargeable disposal of a chargeable asset by a chargeable person. Yeah, so for a chargeable gain to arise, there must be a chargeable person. So for an individual, which is what we're doing now, will be a person, a chargeable disposal, a disposal of shares or securities. Yeah, and a chargeable asset. The asset will be the shares and securities that they hold in that particular company. If 3 of these conditions are not met, where there's no chargeable person, a disposal, or an asset, then there will be no charge to tax for a chargeable gain. Okay, so these 3 conditions must be met, whether you're individual or company. So a chargeable person for corporation tax will be a company. A chargeable disposal will be the disposal of shares in the company, and a chargeable asset will be the shareholding in that company. Yeah, the shares that they hold in that particular company. Now, in terms of when you look at the first chapter, you go straight into how you value shares. Yeah, for quoted shares. So, if Brunei were to have a stock market, then when you sell your shares, it is whatever the disposal is. So if the shares is quoted, so for example, BIBD, yeah? BIBD is quoted at $5. You sell 1,000 shares at $5. That means your sales proceed will be 5,000. Yeah, $5 times 1,000. But in UK, if you give shares to someone, your family or whatever it is, then you need to ascertain what the valuation of that share is. So sometimes shares are quoted 2 prices. There's a range price between one day. So if a price of a share, say, is between $4.80 and $5 during the day, what do? You take the lowest value, which is $4.80. Then you see what the midpoint is between $4.80 and $5, which is 20 cents divided by 2, 10 cents. It becomes $4.90. Yeah. So in the UK, it is easy to ascertain what the market value is, because the stock exchange daily official list provides the low and high price of a particular share in a day. Yeah? So where do we need to ascertain what market value is? Because market value is needed because this is the starting point for calculation of chargeable gain or loss. Yeah, so you need to know what the market value is in order to calculate what that gift is, or how much you dispose your shares of as a starting point. Yeah? So you have a chargeable person, which is the person that gives the shares. The disposal is the value of between the whatever the price is in the stock exchange, and the asset is that shares that has been given. Yeah, so it doesn't mean that you give something away. you are not liable to capital gains tax. You're still liable to capital gains tax on the increase in the value. Yep. Now, there are some rules in terms of for individuals, and the rules are slightly different for companies. So when you dispose of shares, so you have bought a number of shares over a period of time and you decide to sell, there are some special rules for matching of shares sold with shares purchased. Now, in terms of individuals, obviously, shares disposal are matched with acquisition in the following order. Yeah, so if you had to do an exam, you must memorize the order in how you net off or match the disposal with your acquisition. Same day acquisition. So if you sold shares today and you actually bought some shares today, and you need to match it against the same day acquisition, don't worry, there'll be an example later. Yeah, acquisition within the following 30 days. Yeah, so if there's more than one acquisition, then you do it on the first in, first out, and any shares in the share pool. Share pool example also, we'll go through an example what a share pool is. So it's important to memorize these rules because for corporation tax, it is slightly different rule than individuals. So usually in exams, there'll be one example for calculating chargeable gains for individual and another example for companies. Yeah, so that I can see whether you have remembered the rules and to ensure that you have actually done the matching correctly, yeah, in terms of the disposal. So what's the share pool? Now, in terms of shares acquired, again, we treat any shares acquired other than those that's been acquired on the same day and the following 30 days as a pool. Yeah, and this pool will grow or will constrict or shrink, yeah, depending whether you acquire or you sell the shares. Now, in exams, it's important that you always show the share pool calculation, even though you can get the answer correct without showing this calculation. Sometimes 40% of the marks are basically showing the movements in the share pool. So, and not only in exams, but in reality, in real life, when you actually submit your tax computations to the authorities, it is important that you keep track of the share pool when you compute your chargeable gain or loss. Yeah, so it's very important that you need to know how to keep track of the number of shares and the costs of shares. So I think probably the next one is just going through this one. Okay. So in the case of a disposal of the cost attributable to shares disposed, these are deducted from the amount within the share pool. If you have a proportional, so you have say 4,000 shares in the pool and you dispose only 3,000, then the proportion of the cost of the disposal is to be taken out, yeah, of the pool. The best way to do it is to go through these two examples, yeah, that we have. So if you can turn to page 234 of your textbook, there are two quite simple examples, but they always come out in the exams, yeah, just to see whether you understand what the pool is. So let's take the first example, Oliver. In August 2006, Oliver acquired 4,000 shares in Twist PLC at a cost of 10,000. He sold 3,000 shares on 10th of July 2018 for 17,000. Compute the gain and the value of the share pool following the disposal. Okay, so the first thing that you need to know when you calculate your gain or loss is there has to be a proceed, there has to be a cost, and the balance is either your gain or your loss. Yeah, if you remember last week's pro forma template in terms of the calculation of chargeable gain. So if you just go through the answer, the proceed is straightforward. Yeah, we sold it for 17,000. So what you need to do is look slightly below, which is the share pool. And it says working share pool. The share pool is always got two headings only. In this case, yeah, but for corporation tax, there's three headings. So for personal income tax, for individuals, there's only two headings, the number of shares and the costs of the shares. Yeah, so we acquired 4,000 shares for 10,000. We disposed of 3,000. So the cost of that 3,000, just do a proportional calculation. 3/4 times 10,000, which is 7,500. And the balance of the pool is 1,000 shares, and the cost is 275. So you have a proceeds of 17,000. Your working in terms of the cost is 7,500. So the gain is 9,500. Okay. If he has no other income, that means he will not be paying any tax, because the annual exemption is 11,550, yeah, per the tax table. But for the purpose of illustrating how the share pool works, just follow this example. So it's quite a straightforward example. If you don't understand, you just go through it. It is quite easy to follow and understand. Okay? So far, okay? The first part? Yes, no, yes, no?
Okay, sir.
Okay, now. So the second part, now this is a popular exam question, which usually 90% of students get it correct. Some do make careless mistakes, yeah. But again, you have to remember the rules. Yeah? Okay, Anita has acquired shares in Kent Limited as follows. So just going through slowly. 1st July 1996, 1,000 shares for 2,000. 11th of April 2001, 2,500 shares for 7,500. 17th of July, 500 shares for 2,000. And 10th of August, 400 shares for 1,680. Anita sold 4,000 shares for 16,400 on 17th July 2018. You are required to calculate the net gain on sale. Okay, so that's a clue already in this question. She will show a net gain. Yeah. So if you come up with a loss, then there's something wrong with your calculation. So she sold 4,000 shares on 17th of July. So when you do the matching, the first thing you need to do is first match the disposal with the acquisition on the same day. Did she buy any shares on the same day that she sold her shares? So she sold 17th July. She did buy 500 shares on 17th of July. Yeah. So the first part of the proceeds, you need to do a proportion. Proportionate the proceeds 500 divided by 4,000 times 16,400, which is 2,050. Yep. So that's the proceeds for that particular disposal. Cost is 2,000. Because she paid 2,000 for these 500 shares, so she has a gain of 50. Okay, so that's the first part. The second part is to match the disposal within the acquisition in the next 30 days. So 17 July, what's 30 days after that? About 16th of August. Here is 10th of August. So yes, she did acquire shares within 30 days of her disposal. So then it's 400 over 4,000 times 1,600 to give a proceed of 1,640. How much did she pay for it? 1,680. So she has a net loss of $40 from this, £40 from this transaction, yeah, from this matching. So we've done the first part, matching on the same day. We've done the second part, matching the acquisition within the next 30 days. The balance of that, which is 3,100, will be done through the share pool. Okay. So in the share pool, you just look at the workings. Yeah, you have the number of shares acquisition, 1,000, 2,005, total of 3,500. What's the cost? You add up the cost, 9,500. Disposal, the balance is 3,100. Yeah, so we've already taken account 900 shares. So the balance in the pool is 400. Cost of 1,086. So go back to the workings. In order to calculate your gain or loss, you need to have proceeds. Proceeds against proportional against, yeah, the proceeds to 3,100 divided by 4,000 times 16,400. Less the cost, which is the working shown below. You have a gain of 4,296. So the net gain will be 50 plus 4,296 less a loss of 40. Yeah, to give a net gain of 4,300. 6. So if she disposed of 400 shares in subsequent years, then you just take the proceeds of the 400 shares less 1086 and see whether you have a gain or loss in the future when she does dispose of her shares. Okay, so this is the matching rule. Yeah, matching the disposal against the 3 sequence. Okay, so it's always important to remember how to match: acquired on the same day, disposal within the next 30 days, and also any balance will be done through the share pool. I think it's quite easy to follow. Yeah, so even if you don't totally understand, doesn't matter, but as long as you understand the principle about how gains are calculated. Okay, so far so good. I think the examples in the textbook is quite easy to follow. Yeah, if you're ambitious enough, you can go to the back and look at the question. Okay, I usually test you all from here about bonus and rights issue, because have you all studied bonus and rights issue? Don't look at the textbook. You can cheat if you want. But have you heard of bonus and rights issue? Because you should cover it in financial reporting and financial accounting. Yes, no? Never heard of what a bonus share is or rights issue is?
I've learned that before.
But cannot remember.
Yeah, cannot remember clearly.
Okay, there's no trick to what a bonus. Oh shoot, hang on. Okay, there's no trick to what a bonus and a rights issue is. Okay, so what are bonus shares? Bonus shares are basically what the name suggests. Yeah, these are shares issued by a company in proportion to each shareholder's existing holding. So if you have 1,000 shares in BIBD and BIBD decide to give a bonus shares of 1:1, that means you'll be given free shares of 1,000 shares at 0 cost. Okay, so that's what a bonus share is. A bonus share is issued at no cost to the shareholder. Yeah, so when a company issues a bonus shares, all that happens is that the size of the original holding increases. Yeah, so from 1,000 to 2,000 shares. Since bonus shares are issued at no cost, then there is no need to adjust the original cost. This will have an impact on the share pool, okay, and how you compute the share pool. I think that's an example later. Okay, what are rights issues? Rights issue, as the name suggests, is if you hold 1,000 shares in BIBD and BIBD decides to issue a 1-to-2 rights, that means for every 2 shares you hold, you have the right to purchase 1 share. Yeah? So if BIBD decides to do 1-for-2 rights issue, you have 1,000 shares, and it will offer you the rights to buy 500 shares. Okay. As a shareholder, you will be given first right to purchase the rights. If you decide not to take it, then you have exercised not to fulfill your rights, and someone else can buy the 500 shares. What will happen is, if you do not take out your rights issued, then your percentage shareholding will reduce. Yeah, because instead of, say, 1,000 over 10 million, you only hold 1,000 over 15 million, for example. Yeah? So your shareholding percentage decreases. But with a rights issue, you have to pay for it. Yeah. So the difference between a bonus issue and a rights issue is that in a rights issue, the new shares are paid by the shareholder, and this results in an adjustment to the original cost. So when a company makes a rights issue in the share pool, yes, your number of shares increase, but your cost also increases by the amount of the rights that has been issued. Yeah. So let's look at the example on page 235. Very straightforward example. Sarah has the following transaction. She bought 10,000 shares for £15,000, took out a rights issue of 142 at £2.75, and then she sold 2,000 shares for 6,000. Now, the most common mistake that students have made is they misread, took up a rights issue of 142. They do it the other way around. So for every one shares, they assume that they've bought 2 shares instead of the other way around. Yeah. So let's look at the answer. What you need to do is to do the share pool first. Okay. So we acquired in 1997 10,000 shares for 15,000. Yeah. So that's the first line. Then we took up a rights 142. 142. So for every 2 shares, we're entitled to 1. Yeah. So it's 5,000. The common mistake that students do is instead of 5,000, they put 20,000. Yeah. So they assume that for every 10,000, I can get 2 shares for every shares. So then the number becomes 30,000 instead of 15,000. Then that will have an impact on the cost as well. So the 5,000 shares was at £2.75 to give you a cost of $13.75. So your pool after the rights issue is 15,000 shares, 28,750. We sold 2,000 for £6,000. So then just do a proportional, yeah. 2 divided by 15 times 28750 will give you your cost, and that is the gain. Okay. So this is a rights issue. Now let's assume that the company did a bonus issue, but the same proportion. Yeah. So instead of a rights, the company has given a bonus of 1 share for every 2 shares that you hold. What would happen in the share pool then is on your line where it says rights issue of 5,000 shares, the cost will be 0. Okay, so there'll be no cost because a bonus issue is issued to shareholders at no cost to the shareholders. Yeah, then your cost will be 15,000, number of shares 15,000. Your gain will be the cost of 2,000, so your gain will be 6,000 minus 2,000. The gain will be 4,000. Okay, so the impact of a bonus issue is when you dispose of your shares subsequently, you will be showing a higher gain as opposed to a rights issue. Yeah, so common sense will tell you that if you have shares, you get shares for free, but you pay for rights. Obviously, the gain in the same scenario will be you'll be showing more gain with a rights with a bonus issue compared to a rights issue. Okay. You can look at the next example, reorganization and takeover, if you want to, because then it gives you an example of how some companies, when they take over, they exchange shares from one company to another. When you do this, you need to look at market value and everything like that. But if you don't look at it, don't look at it. So if you want to just understand individual, just go up to bonus and rights issue. Yeah, just go up to page up to the answers on page 236. The rest of it you don't need to look at it. Obviously, in exams, made tests would have test some. Would have included some reorganizations or takeover in the question, but it's probably on corporation tax rather than individual tax. Yeah. So that is the end of personal income tax. Yep. This is the last syllabus on personal income tax on shares and securities. So over the last 2 months or so, we have covered computing taxable income, employment income, partly covered property income, computing trading income. We've looked at capital allowances, partnership, and and now computing and then chargeable gains last week, plus going through in passing business relief, and now finally the last chapter for personal income tax is shares and securities. So if you remember, or if you've actually gone through the tax, you can see that for different methods of computing tax, there is a different pro forma. Yeah. So for computing taxable income, you know that there's 3 columns: savings, non-savings income, savings incomes, dividends. When you calculate your capital allowances, yeah, you need to understand what is your annual investment allowance, your pool first year allowance. So they're proper columns. When you do partnership tax, you start with total first and then the names of the partners. Yeah, the reason why you start with total first is because you need to calculate the balancing figure, which is the share of the profit, and the share of profit is distributed to the partners based on their profit sharing ratio. And then computing chargeable gains, it is proceeds less costs or all other incidental costs to give you your net gain or loss. And securities, the important thing is to remember is the matching rules. Same day within 30 days and the share rule. Okay, so now I want to cover, if I can find it, chargeable gains for companies. Okay. Basically, this is chapter 20, page 309. Chargeable gains for companies are computed in broadly the same way as individuals, yeah. But instead of annual exam allowance that they get, for companies you get what is known as indexation allowance. Yeah. So you get indexation allowance, but no exam allowance. The exam allowance is only to individuals, 11,550. Indexation allowance, I'll cover it a bit later. Yeah. So companies do not pay capital gains tax. Instead, the chargeable gains are included in the calculation for taxable total profit. Taxable total profit I will cover next week. Yeah, for corporation tax. Now, in terms of the matching rules, a company's capital gains or allowable losses are computed in a similar way to individuals, but with a few differences. Okay, and then we'll go through the matching. There's relief for inflation. So what indexation allowance is takes into account is, say if you bought your BIBD shares 10 years ago, yeah, at $2 a share. Because of inflation, the cost 10 years later will be much higher, yeah, because of inflation. So if you use in Brunei the retail price index or the consumer price index, I think Brunei we call it CPI, consumer price index. When you take into account inflation, the $2 could be maybe $2.20. Yeah, so your cost base increases because of inflation. That's what the indexation allowance is, to take into account inflation over the period of time. No annual exam amount is available, and there's a different matching rule for shares that apply if the shareholder is a company. I think the next slide is probably the rules. No, not quite. Okay. So indexation allowance gives relief for the inflation element of a gain. Yeah. But in the UK, they froze it from 1st January 2018. The indexation allowance removes the inflation element of a gain from taxation. Yeah. However, after 1st January, the inflation element of the gain will be taxable. So I'm not sure why the government removed the indexation allowance after 1st January, but that appears to be the case here. But they can always reintroduce indexation allowance, because in the UK, the tax budget is presented. Actually, the budget was presented yesterday, in the UK. But for the purpose of tax rates and all other relief and incentive, that is usually applied from 1st April every year. So there'll be 1st April next year, they could reintroduce indexation allowance. Yeah. So again, if an asset is acquired after or 1st January 2018, there'll be no indexation allowance. The indexation factor is calculated based on what the retail price index is on the date of acquisition, on the date of disposals. So if you dispose your BIBD shares today, you look at what the CPI is today, less the CPI of what is 10 years ago when you bought the shares, divide by the retail price index on the date of acquisition. So that gives you your indexation factor. Actually, in the past, in exams, you had to calculate the indexation factor yourself. You'll be given all the information, then you need to calculate it. But in recent exams, the indexation factor is given to you. You don't need to do this calculation, the indexation factor calculation. Yeah? That figure has actually been given to you. So they've made life a bit easier for you all. Yeah, okay. So disposal of shares by companies, these are the matching rules. For companies, the matching of shares is in the following order. Similar to individual shares acquired on the same day. Yeah, did we acquire any shares on the same day? Shares acquired in the previous 9 days. For individuals, it's the following 30 days. Yeah. And then shares from the FA, they just call it FA 1985 pool. That's a term used, it's been used going back to 1982. So as to why it's called FA 1985 pool, that was what was used by the tax since 1985. Okay, so let's have a look. Now, the FA 1985 share pool comprises of the following shares of the same class in the same company. And these are usually shares held by the company on 1st April 1985 and acquired by the company on or after 1st April 1982. Shares acquired by the company on or after 1st April 1982. And again, just like the share pool for the FA 1985 share pool, we need to keep track of the number of shares, the cost of the shares, ignoring indexation, and the index cost of the shares. So for corporation tax, you have 3 columns when we look at the pool. The share pool for individuals is only 2 columns, which is number of shares and costs. For corporation tax, there's 3 columns, yeah, which is number of shares, costs, and your index cost. We will go through an example, then you can just look at it, yeah, and see how it's done. So if we look at the textbook, there are a number of examples given. Let's have a look. So okay, let's look at Oliver, because Oliver is an example that follows through all the way. Yeah, the 3 example is just a follow through of the facts. Yeah, so I think this is quite a good example to look at. All right, and it follows the above example. Hang on. Okay, so example of the FA 1985 pool. Oliver bought 1,000 shares into this for 2,750 and another 1,000 in 1984. Indexation factor is 0.055. It's given to you here. So as I mentioned to you, in the past, you will be given the RPI for August, April, December, and 1st April, and then you are required to calculate the indexation factor. Yeah, so this is where a lot of students may make careless mistakes because they may take the wrong CPI for the wrong month. But in this case, it's all given to you. So when you look at the pool, the start of the pool is no different than the share pool. Yeah, number of shares, cost, the index cost has not been included yet because it's still the same as cost. Then you have your indexation allowance. Indexation allowance 0.055, which is the factor given to you, times 275, and so on. And for the second pool, the indexation is 140. So the index cost of the pool at 1st April is 6291. Don't worry, you don't fully understand. But when you go through this whole example, yeah, from here to the next 3 pages, next 2 pages, it is just a follow through of the information that's been given from one stage to the next. Yeah. So that's the first part. On 1st April, we've already established what the pool is. There's 2,000 shares. The cost is 6,000. The index cost is 6291. Okay. Now, if we follow on to the next one, the question is, following on from the above, assume that Oliver acquired 2,000 more shares on 10th July at a cost of 4,000. Recalculate the value of the pool on 10th July following the acquisition. Index factor is given as 0.028. With corporation tax, every event that occurs means you have to recalculate the index cost of the pool. Okay, so in this case, we've only done an acquisition. Yeah. So if you look at the next page, the value at 1st April 85 is the figure brought forward from the previous example, 2,000, 6,000, and 6291. Indexation costs, the index factor is given to you, 0.028 times 6291, yeah, to give you 176. We acquired, so that brings you to the index cost at 10th of July. We acquired 2,000 shares for 4,000. So you just add number of shares, 2,000, cost, index cost. There's no index cost because that's the date of acquisition. And this is your pool at 10th of July 1986. Okay, 4,000, 10,000, 10467. The next 2 example will be a disposal on the share pool. Yeah, and then how you have to take into account in the share pool. Now let's look at the next example. But if you don't understand it, just go through it later in your free time so that you can get some understanding, yeah, how it works. The only difference between individual and the corporation tax is the index cost column. Yeah. So if you can understand the index cost column, then you are 90% on the way to understanding the calculation of chargeable gains for companies. So in the following example, we have a disposal. So at the start, we have what is known as the share pool, the pool, the 1985 pool at the start. We acquired more shares. So that's what the pool is up to the date of acquisition. Now we have, what have we done? Continuing the above exercise, suppose that Oliver sold 3,000 shares. Okay, so he sold 3,000 shares on 10th of July to 2018 for 24,000. Compute again the value of the 1985 pool following the disposal. And then the indexation factor has been given as 1.852. And then from July 1986 to July 2018 is 1887. So the value of the pool brought forward from above, yeah, you just use the same figure, 4,000, 10,000, 10,467. There's an indexation rise of 1.852. That's the factor that's given here. Yeah? So you have at the date of disposal 4,000, 10,000 plus 29,852. Yeah, we dispose 3,000 shares. Then you just do it by proportion basis. 3,000, so 3 over 4 times 10,000, so cost for 7,005. 3,000 divided by 4,000 times 29,852, which is 22,389. Okay, so that's the balance of the pool now: 10,000, 2,005, and 7,463. So what is the gain? The gain will be proceeds. Yeah, you've been given above, like I said, this, he sold his shares for 24,000. So it's 24,000 minus the cost. What is the base cost? 7,005. Less indexation allowance. The indexation allowance will be the difference between the index cost and cost, which is 14,889, to give you an index gain of 1611. Now, if you do 24,000 minus 22,389, which is the index cost figure, you still come to the same figure of 1611. In the exam, you'll be penalized, okay? Because you need to show the split between costs and the indexation allowance. Although you get the same figure, the gain of 1611, by using that aggregated figure. But for exam purposes and for presentation purpose to the tax authorities, you need to split, to show the split of costs and indexation allowance. Okay. And then following on this example, I assume that there will be some disposal. So continuing above exercise, suppose that Oliver sold 200 shares on 18th November for 1,800. Compute the gain. Where is it? Okay, so you have carry forward 1,025, 7463. The cost has been, where's the cost? The cost is, 2 divided by 1,000 and so on, yeah. And what's the gain? Proceed is 1,800. That's the cost of 500. Less the index allowance 993 to give you an index gain of 307. So when you go through the example, just go through it slowly. Yeah. To me, this example illustrates how you start from the FA 1985 pool. When you have an acquisition, what's the impact on the pool? And then when you have a disposal, how the disposal is calculated. Yeah? So every transaction, you need to recalculate the index cost so that when you do the deduction, you have taken the right figure. Indexation cost has an impact of reducing your gain, because of the indexation factor and because of the inflationary impact that has been taken into account to the increase in the cost over time. So time value of money. Now, of course, there are some other examples here as well. Bonus and rights issues, the same thing. Bonus, there's no cost. Rights issues, there's a cost element. But even though with a bonus and rights issue, the difference between this and individual, we still need to do the indexation cost. Indexation price over the period of time. So there's an example here, and then reorganization and takeover. I won't look at that if you don't want to. So I think for the purpose of just to demonstrate the differences between corporation and individual is the impact of index cost. So companies will get indexation allowance. Individuals do not get indexation allowance. Companies get indexation allowance. Individuals get annual exam. Okay. So if you go to page in the tax tables on page 495 under capital gains, you can see that annual exam amount is 11,700 for individuals. Okay, so that's all given to you. Okay, so I think that's basically it, really. So the important thing with these two chapters is the matching rules, how the share pool for individuals is very straightforward. You just add or take away additions and disposal in the proportion of the disposal. The only thing that probably is a bit more complicated is the individuals for corporation, where you have to take into account the indexation allowance. The most careless mistakes, obviously, for students in exam is two things. One is using the wrong indexation allowance factor, and the other one is not taking into account the indexation index costs. Yeah, so that's it really for this lecture. I just wanted to keep it to 45 minutes to 1 hour. I don't want to over drain you with. Usually what I would do, I mean in class, I will do this example on the board. Yeah, because it's easier for me to demonstrate on the whiteboard how this works. And to me, it's easier when your hand is writing. When you write something on the board, it registers on the head. Then you get used to doing the columns. You get used to doing the format and pro forma. Yeah. But I said, because you're not doing any exams, the formatting, the pro forma is not as important for you for this semester. So in a sense, you are lucky. Yeah, okay, so you only have to do assignment. So any questions on this? Two topics. Actually, if you go through the textbook, chapter by chapter, individually, each chapter, it is not complicated. Taxation is not complicated because if you practice the tax computations, whether it's in the book or in the exercise at the back, you will find that it's not that difficult. The only problem is after 2.5 months of going through taxation, there's so many things to remember. Yeah. So sometimes students get confused about which format, which pro forma, which rate, what figures do I use in the tax table? Because there's, as I said, when you go through each chapter, it's not that difficult. But when you have to accumulate the knowledge of so many different taxation, from personal income tax, capital gains tax, chargeable tax, different rules for normal disposal, different rules for shares and securities, different rules in terms of calculation of capital allowances, what is allowable, what is disallowable. Then when there's so many things to remember, little things may sometimes confuse students. Yeah. So fortunately, you're okay so far. Yeah. So that's it. So you either have one more lecture or 2 more. I will see how detailed is the other topics are. When's the last day of your lectures? Supposed to be mid-November, end of. When is it supposed to be your exam study period? Any idea? No idea. Okay, so that's it. That's it. So next week it'll be computing taxable total profits and the corporation tax liability. Yeah, that's chapter 19. In fact, if you look at the losses chapter, actually maybe I think I better not do both. I'll do losses separately. Yeah, because it will totally confuse you. So okay, so there'll be 2 more lectures. Okay, so that's it really. Yep. So I'll see you next. Well, okay. I will speak to you. Not see you. I'll speak to you next week. Yeah, on the second last chapter, and then the week after that, final chapter. Then that's it. Then just as I fly back to Brunei, quarantine, and hopefully everything is okay in Brunei. Okay. So that's all from me. Enjoy your lunch and take care and stay safe again. Okay. See you guys. Bye.
Thank you, sir.
Thank you, sir.
You're welcome.